A very good evening, everybody. We have a lot to get through this evening. We are seeing a continuation of the confusing picture out there in the UK property market. Over the last week, I have seen articles from Savills saying we're going to see up to 20% house growth over the next 5 years. I've seen articles from a think tank consultancy saying they think house prices might be back to the peak by the end of 2024. We've seen Halifax and Nationwide house price indices both come out in October showing house prices. Today, we've seen Rightmove index seeing a massive slash in property prices. Or let me refresh that, in asking prices for property. We've seen Zoopla talking about dips over this year and next year. So the question is, who is right? How do we understand what's actually going on and what the real picture is in the UK housing market right now? Because we are at that inflection point where we can see the sentiment, the zeitgeist, if you like, from the public or from the media is equal amounts of negativity versus positivity on either side, and that shows we're at that sort of inflection point. So I want to understand where exactly we are, what the data is really showing us, and what we can do to understand the trajectory over the next 6 months to 12 months. So first of all, if you're on the live and you can see me and hear me all right, please give me a thumbs up. Please find the comments section and put something in the comments. I know we had some audio issues last week. Hopefully that's not going to be the case. If you're watching on the replay, please do ask those questions, put those comments in as you go through, and I will always answer those for you. So let's crack straight into it. I want to give you the agenda of what we're going to be talking about and unpacking this evening, okay? I want to talk about why we're getting this confusing picture. And then I want to look at what threats we have, both to the UK housing market, but also to our economy. So what are the underlying issues that we are facing as a nation in both of those things? Because remember, they're symbiotically linked. Okay, I want to talk about those crash triggers and focus in today on unemployment and why that's super important. And then I want to also unpack an article that I saw a lot of people talk about last week, which is the Savills house price forecast over the next sort of 5 years to 2028, which is, of course, a lot of those clickbaity headlines about property prices to surge, all of that sort of stuff. And then we will end on a discussion about CPI, and we'll have a little sweepstake as to where we think CPI is going to go on, is it Wednesday that it comes out? So that's what I want to talk about this evening. So let's start with this confusing picture and why we are seeing this confusing picture. Last week, and we did lives on both of these, we kind of unpacked the data. We saw both Nationwide, which is the bottom one, that gave us a 0.9% seasonally adjusted. We also saw Halifax, which is one at the top, give a 1.1%. Now, this is month-on-month change. Now, on the face of it, that seems like some quite large month-on-month changes, right? You pro-rata that 1.1%, you're over double-digit growth. And when we look at the housing market, okay, all logic should say that we should be in free fall by now. All logic says that the interest rates where they are, the rapidity of how quickly those interest rates have gone up, should see those property prices coming down. And of course, they're not as quickly as a lot of people, a lot of commentators might want them to go down. And when you see the headlines saying actually month on month we've gone up 0.1 or 1.1%, it's like, what's actually going on? Well, here's the thing with both of those data sets. Taken in isolation, it's a confusing picture, but when you look at what's actually happened, when you look at the absolute pitiful amount of transactions that are happening in our property market right now, we can see that the market is in paralysis. The market is in paralysis, and there's such a small data set that's skewing the data. And don't forget that these are models, they're called hedonic regression models. It could well just mean that the average price of properties being sold are higher, right? Which means more people are selling higher value homes, and that filters into the hedonic regression model. It can also be filtering in the price per square foot are higher that are selling. So actually, when you look at it, we did a load of analysis on this about 4 months ago. When you look at the smaller, denser properties that are selling, which actually support the first-time buyer market, when you look at that and you look at price per square foot, smaller properties are often a higher price per square foot because they're smaller, right? So it's not just a linear change in price per square foot as a property goes up. Generally, as properties get bigger in an area, the price per square foot in an area will go down. That's just how it works. And when you build price per square foot, which is one of the sort of elements in a hedonic regression model, if you're seeing more of those sort of properties being sold, then again, that could skew the data. So don't forget, we see this is very skewed data when we've got such a small data set. So that's the first thing that I think is really important to understand here, that these are snapshots from lenders with using their own house price indices without knowing exactly what is going on behind that. Now, here's the big concept that we need to take away from this. the effect of the interest rates are still only just feeding into the system. And this is really important because even the governor of the Bank of England last week, when he talked about the interest rates going on pause again, one of the things he said was that only half or a little more, and these are the words he used, half of the pain of interest rates is yet to be felt among households, since many are still on lower mortgage rates and will see their mortgage payments increase in the coming months as they refix their deal. So this is a big thing, right? Those interest rates are still feeding through. We're only halfway through, and we're going to look at some data in a bit to see some stats, see how everything's creaking with the interest rates as they are. And if we're still only halfway through and we've got that amount to keep going, imagine what we're going to be seeing in 6 to 12 months' time. Right now, we still have 110,000 mortgage holders every single month coming off cheap fixed rate debt of 2% or lower and having to refix on a higher interest rate product, right? The bigger that gap goes, the more people are going to be feeling it, the more that's going to start filtering in to the system. And don't forget, we have to link all of this with the economy as well. So house prices and the economy are symbiotically linked. A lot of it about is perception of wealth, perception of spending power. If our house prices are coming down, then we think we have less wealth, therefore we spend less, and therefore the economy shrinks. Conversely, if the economy shrinks, right, which we have a fall in GDP, very often that will lead to unemployment. People have less money spent, therefore that filters in the house price. So it goes around cyclical. So the two are symbiotically linked, and we need to understand what's going on with both at the moment. And the interest rates are not just feeding into the housing market, okay? The interest rates are feeding into the economy as a whole, and it's feeding into businesses as a whole. And what I'm going to do over the next 5 minutes is look at the major threats to our economy, because if we've still got this amount of interest rate effect to feel, we need to understand where we are now as a snapshot, and then think, blimey, if we've gone from post-pandemic 0.1% interest rates to where we are now, if we're only halfway there to the full impact, what's the actual impact going to be for the next half year, and how's that going to influence everything, right? Before I do that, I'm going to try something today. I want to give you a message from myself, just talk about my aim and growing this channel. So if you'll indulge me for 40 seconds or so, I'm going to pass you over to Past Me. For those of you who are regulars, you'll know that I'm fascinated by data. And when I look at the channel stats, I can see that just under 65% of people who watch my videos aren't actually subscribed to the channel. Now, I do know this stat actually way above the average for YouTube and shows the power of the community that we're building here. But I want to do better, and I'd like to make a deal with you. I've got a vision to empower as many people as possible on this planet to take ownership of their futures using income-producing assets to reclaim your time, freedom, and choice. And if you can just hit that subscribe button, I'll work tirelessly to grow this channel, make it better and better for you so we can fulfill that vision together. I cannot tell you how much it helps. As the channel gets bigger, I can put more resources behind it, improve the production, the content, and ultimately the value that I give to you. So if you could do me that small favor and hit that subscribe button now, as well as the like button on this video, it would mean so much to me as we continue to grow this community together. It's the only favor I'll ever ask you. Thank you, and let's get back to the episode. Cool, so please do hit that subscribe button. Look, I don't usually go self-indulgent, talk about numbers, but we are on the verge of hitting 3,000 subscribers. When I started the channel in March of this year, my aim was to get to 1,000 in the first 12 months. So that would be 1,000 by March 2024. We hit that ages ago. I then set an aim, we're getting to 3,000 by Christmas. We should hit 3,000 today or this week sometime. So we're looking to sort of smash that out of the park and then hit 5,000 within the year. So please, it'd be great if you could help us do that. Right, let's get back to the slide deck. So what I'm going to do now is I'm going to talk about these macro factors that are feeding into both the housing market and the economy, so we understand what's going on. And one of those is the continued rise in mortgage costs, okay? So we are not out of the woods for this yet. So I talked about this last week. This is a graph and an article that came out that talked about how our mortgage rates are now coming down, okay? And they have been coming down for a while. And they're projected to come down, or some people think they're going to be sub 4% by sort of August next year, 2024. I'm not going to go too much into the whole swap rate thing, but effectively, don't forget that mortgage rates are set on something called the swap rate, which isn't the Bank of England base rate, and a lot of that is about future pacing projections forward about where the interest rate is going to average over that time period. So a lot of people are saying, look, mortgage rates are on the way down. We've peaked. We're on our way down. And as we go down, that's going to increase people's affordability. And so therefore, this is going to be this soft cushion to the housing market and going to start, allow it to kickstart again when we hit a certain mortgage level. And that's fine in theory, but it negates the argument that so many people are still on. So if we look at this, right, so this is down at 4% down here. if actually loads of people are still down all the way here and they're coming off their fixed rate, and the fixed rate is now kind of going actually all the way up here, even though we're not at 6.5, 7% on your 2 to 5 year fixed rate mortgages, you've still got all of these people coming off and having this massive jump up. So the people that are getting, and by the way, there's going to be a lot of people who have fixed over the last 12 months onto something that's quite a lot higher and are now probably stuck on 5.5, 6%. Okay, so just like as when the mortgage rates go up, it doesn't affect everybody equally. As they come down again, it's not just going to immediately feed its way into the system and everybody's going to be seeing their mortgage rates declining. Okay, you're still going to be seeing over 1 million, 1.5 million by the end of 2024 who are going to be hit by massively higher mortgage rates than they are experiencing now. And this is despite the predictions of our interest rates in the UK, or Bank of England base rate in the UK, staying higher for longer. So we talked about this a couple of months ago. This was the interest rate prediction, Bank of England interest rate prediction by the IMF, which said we could be above, sort of 6 or above 5% well into 2025. I don't think it's going to be that bad. I think that was pessimistic. But because of how we're faring in terms of inflation compared to everybody else, there is an expectation that our base rate is going to be higher for longer. So the mortgage rates and the swap rates can only come down so much, right? If we sit at 5% interest rate, base rate for the next 12 to 18 months, it's unlikely in that period we're going to be sitting, sub 4% on mortgage rates and swap rates, unless we think it's suddenly going to nosedive, or unless banks are tricking us by having really low interest rates to entice us in, but then putting huge mortgage fees on a 2-year or 5-year fixed mortgage, which when you put it into it actually means it's just as expensive in the first place. Okay, research by the Bank of England. If we have a look at this one in particular, okay, this is from one of their recent analyses. This is Bank of England, not owners. This is a Bank of England report saying that by the end of 2026, okay, we're going to see almost double from where we are kind of the end of 2023, which is not there yet. So we've still got a little bit of way, a month and a bit to go to get to the end of 2023. Double where we are now in terms of mortgages that are increasing by £200 a month, over double where we are now of people who are increasing by over £200 to £500 a month. And look at that, that's probably around 4 times the amount of people whose mortgages are going to go up by £500 a month or more between now and the end of 2026. That's 3 and a bit years ago. So that's huge numbers. Okay, so these mortgage costs are still ramping up. And if we have a look at this next slide, which I've actually zoomed in to make it easier, this is the effectively the UK. This is the collective spend of the UK on mortgage. Don't forget, not everybody owns property on a mortgage. Only about a third of people own property on a mortgage. But this is called the debt service ratio. And you can see the Bank of England's prediction is it's going to continue up and start to level off, but still going up by the end of 2026. So people are still going to be hit by affordability, and people are still going to be hit by eroding pay packets. Now, it waits to be seen how nominal wage growth continues. We've obviously seen extremely high nominal wage growth over the last 12 months. Is that going to continue at the rate it is? I'm not convinced. I think wage growth is starting to, probably has peaked. Wage growth is starting to come down, even though we're now going to real-time wage increase, because wage growth at the moment is above inflation. If we start to see this wage growth come down and nominal wage growth come down, okay, it's going to make it even more difficult for people. So we cannot take our eye off the ball that mortgage interest rates are still going to be feeding through. That's the first thing. That's the first threat to the market and the economy. Because, of course, if we're spending all this extra money on our rent and our mortgages, we're going to have less money, less disposable income to spend on other things, to spend on consumables. This is going to feed in to the economy. So let's look at macro factor 2. Oh, by the way, I just want to say, I can see plenty of questions coming on. Keep coming with the questions. What I like to do is get through the slides early. Get through the slides so we can get through all the data, have a talk about it, and then we'll get back and answer the questions. It's mainly so people watching on the replay will be able to just get through the content, and then we can go to Q&A afterwards. So please put your points and questions in, and we'll have the discussion afterwards. By the way, just on this fact, I just want to come back to this. As a sort of ad hoc narrative, if you like, I'm seeing a lot more people coming into the videos and putting comments on where they're saying that even though they have good salaries, they have good careers, they haven't had to worry about expenditure before, they now are having to actively manage their own household budgets because of cost of living, because of utilities, because of mortgage rates going up. So we can see it filtering in, right? The anecdotal evidence is there that people all through the spectrum are having to watch what they spend, right? And I know that categorically. So let's talk about the falling savings ratio. One of the things that without a doubt has been propping the market up has been the fact there's been a lot of liquidity in the system. Liquidity in terms of actual cash that went into people's bank accounts, liquid cash went into people's bank accounts post-COVID. Lots of money was given out, right? People's, let's just go to this one. You can see here post-COVID, this massive spike in effectively deposits into savings accounts in the UK. We stockpiled a lot of liquidity, and you can see, this is now a little bit old. This is a few months old, this graphic, but you can see how we've been effectively now withdrawing that liquidity. Now, whether we've been drawing that, oh, sorry, that's really random fireworks have just happened on my screen. How bizarre. Anyway, there we go. That's throwing me a little bit. Because we were drawing liquidity, it doesn't necessarily mean we're spending on stuff. It could be going into, locking up into, longer term interest accounts. It could be going to other investments. But the chances are a lot of that money that's flowing out, net flowing out, is going into paying for the extra cost of living right now. Okay, if we have a look at, a mortgage interest payment, we've just been talking about mortgage interest payment. If we want to have a look at that, effectively graph of those interest payments, it's not capital interest, it's fairly obvious, right, the spike that this is having on the UK public, if you like, right? So a lot of that liquidity is going to be servicing these debts. Now, the question is, how long does this liquidity last for? It's tempting to say it's going to run out very quickly. Now, when we look at the savings ratio, it's an interesting graph, taking this from Trading Economics. Effectively, this is a ratio of what we can save into savings and pensions from our post-tax income on a monthly basis. Now, again, we can see in COVID, this ratio spiked massively, and then we have dropped down. But interestingly, right, we've actually seen a little bit of a tick up. I would say we're still, probably below long-term average. This period here, what's that, sort of 2016, 2017, 2019 was low, but the property market also was not performing very well in 2019. Okay, so if we look at this average, we're probably sort of basing 6-7%. We're actually above that at the moment. So I think this strong nominal wage growth is still filtering through. And don't forget, this is the UK as a whole. Not everybody is servicing massive debt. Only a third of UK homeowners are own on a mortgage. And all of those, not all of those are going to be 75% loan to value mortgages, right? They're going to be a spread from, 1 year left to go to 25, 30, 35 years to go. So it's not like everybody's in the same boat here. And because interest rates have gone up and you can now get 5-6% in, very safe interest rate accounts, a lot of people will also be generating additional income stream from their savings for the first time in a long time. So the two are offsetting each other. But it's about the people who have mortgages. That's the thing that's really going to drive the market. But what I think is more interesting is how does it feed into the economy? And I suspect one of the reasons that the economy is staying on the face of it so sort of resilient at the moment is we're all focusing, and I see a lot of YouTube videos, a lot of commentators talking about, wait a minute, how is it not all crashing all around us? Mortgage rates are up, interest rates are up. Well, let's not forget, interest rates go up. There's going to be a subsection of society that struggles, people with large mortgages, people who are basically over-leveraged and probably took too much cheap debt over the last few years. There's also going to be a huge subsection of society who are going to massively benefit from these interest rates going up. People with no mortgages, people with cash savings, all of a sudden are going to have much higher interest rates on their liquid cash savings, or maybe you lock it up for 3, 6, 9 months, but they're still effectively cash savings accounts. NS&I put a over 6% bond out in September. So there are people that are benefiting from this as well. And I suspect there is, because we've still got liquidity in the system. And I'm not going to talk about it today. I also think there's a psychological shift for us as a nation, which is almost like that kind of almost to hell with it, right? If it's all going to go, we're just going to go and have some fun with it and spend our money anyway, rather than hoard it all and lock it up. That's something we'll talk about in a different live, not for today. So that is where we are in terms of falling saving ratio. But the big thing is we do see a net outflow at the moment, and that was backed up with some data we've recently seen about money flowing out of bank accounts. So let's talk about macro factor number 3, and that's the bond market. Now, again, we're kind of recapping here. We've talked about the bond market quite a lot over the last couple of weeks. I don't want to go too much into it. Just to summarize, if anybody's not seen those videos on the bond market, Yields and bond values are have an inverse relationship. So with yields going up, which they've been doing, the value of bonds goes down. On the face of it, not a massive issue unless you're a bondholder and you have to sell it for some reason. If you're a bondholder and you have to sell and the value of your bond has devalued massively, you're going to be taking a massive haircut and you're going to be having losses on that bond portfolio. So who owns loads of bonds? Well, let's say, for example, pension funds have lots of bonds. So with these yields going stratospheric, basically, in the bond market, and the values of them coming down, a lot of pension funds have been forced to sell their bonds, or not sell their bonds. To maintain liquidity, they've had to sell other asset classes, for example, commercial property, which has also seen, so you might not be able to see this, but if we go, a lot of pension funds, and I want to highlight this, I think it's very relevant for the property market. Heavy selling of commercial property and private equity stakes by pension schemes is raising questions over private capital valuations. Effectively, there you go, adding the pension funds were selling office buildings at 35% discount. I've not spoken about it for a while in terms of a video talking about it, but commercial property prices have been absolutely decimated over the last 12 months. For me, it's the massive opportunity in the property investment space right now is picking up commercial property because, of course, it kind of all follows suit a little bit. But to maintain liquidity, right, to prop the pensions up, they've got to sell assets from somewhere. If they're selling things at losses, that's going to cause some markets to collapse, like commercial real estate. So it's a big issue, this. Bond market's causing a big issue for a lot of people, none the least UK government, okay? Because when I say that some people, if people are forced to sell bonds, banks or the government at a loss, that's got to be funded from somewhere. I'm actually, what I should have done is done this one first. I'll come back to it. In fact, just hold that thought. We'll come back to the losses from selling bonds at the current values in a bit, because it's a much bigger number than the one I'm going to talk about, which is macro factor 4, government debt servicing. It's probably no surprise that government's taken on huge amounts of debt, right? Quantitative easing. We've printed all this money, got all of this debt, and the interest rate's gone from 0.1 to 5.25% in terms of Bank of England base rates, okay? That is going to cost UK PLC a huge amount of money, extra money in terms of servicing the debt that we've got. And again, the reason I'm talking about this is now a massive threat to our economy. We're about to start running up to a general election, right? There's going to be some pledges of spending, where they're going to put the money, but most importantly, where they're going to be funding it all, and how can we grow our economy or kickstart our economy back to some sort of growth? Because at the moment, we are totally flatlined. It's not going anywhere. This is not helpful for anyone, and it's kind of limping along, not doing anything. What everybody wants to do is the economy to start growing rather than going into reverse and going into recession. How do we do it? We stimulate growth. What stimulates growth? You need some investment from somewhere. If we got loads of debt that we're servicing, that's going to strangle investment that the government can put into our economy. So this chart shows the higher interest rates, it's the extra debt interest costs since March's projections. So this year we're going to spend about another £2.5 billion than we were originally anticipating just sort of 6-7 months ago on servicing debt. This is anticipated by the time we get to 2027 to be £20 billion of extra. This is not just £20 billion of debt servicing. It's £20 billion of extra debt servicing compared to the predictions. Now let's put that in context. These were the predictions back in March. So you can see the debt interest here, 116 billion, okay, for this year. Now, if we look at that, that's actually, we've got social protection, we've got health, we've got education, are the only three things that are bigger causes of expenditure than our debt pile. And we've now got, if you look at that, when we get to 2027, 2028, another 20 billion to add to that, okay? So we're now on to like 136, right? That's now bigger than education. So we are projected in the next few years that our debt servicing or interest payments on our debt is going to be, we're going to be spending more on that than our whole education system combined, which is a big amount of money that we can't be putting into other places. You know, if you start to add up all of this other stuff, and it's smaller than what we're spending on debt. But that's just with the extra interest rates, okay? Let's talk about macro factor 5, which are quantitative tightening losses. So again, just a very, very quick lesson on how this works. And I don't think a lot of people understand what's going on here. Quantitative easing, right, is effectively government issues bonds which the Bank of England bought, right? So the Bank of England buy these bonds, and when they buy them, they give the government all this money for the bonds. It's basically an IO, where the government gives them, sort of an IOU. Bank of England gives them the money, government uses it to spend on stuff. Perfect, easy. That's how we print money. When we go into quantitative tightening, right, effectively what's happening is the Bank of England is selling those bonds off. But right now, because of where the yields have gone, which are stratospheric, those bonds are massively devalued. So the Bank of England is having to sell those at a huge loss. And if you go back to the small print of when we first started QE, the government committed that the Bank of England sells bonds at a loss. The government will make up the difference. So the Bank of England is not, sort of exposed or paying for those losses. So we, as taxpayers, are paying for all of those losses. Okay, let's look at how much we're actually paying right now for those losses. So the black line was what the OBR suspected we were going to be paying. Now this is cumulative. This is not per month, right? So at the end of August this year, bearing in mind we're now mid-November, we had already spent, what's that, £29 billion covering losses on the QT program to the Bank of England. £29 billion, right? So that kind of dwarfs the extra interest payments we're paying on the debt of £2.5 billion. And I need to find a more up-to-date figure on this, but we are talking huge amounts of money that are going into plugging this black hole with all this debt that we've got and covering the losses from the bonds. This is all money that's being taken away from everywhere it should be going, from stimulating growth, from stimulating investment. I mean, is it any surprise that HS2, north of wherever it was, Birmingham, has been cancelled? We are in austerity, effectively, and none of the figures have actually changed in terms of what the government's spending, even though we're in a massively high inflationary environment. So all those figures are ridiculous anyway. So we're in austerity, but we don't even have a low interest rate to kind of pad that out or to kind of help us through that. We're in a very high interest rate environment, but we don't have any money. This is not a good place to be, and I suspect we're going to see this being a bit of a battleground as we go into the election. And as UK PLC, if you like, it's difficult to see how we kickstart that economy and don't have it slip into reverse. And let's talk about that with macro factor 6, which is business insolvency. So, and we'll link back to the housing market in a sec. By the way, let's just see. We've got loads of comments. I will come back to these comments in a bit. What's your thoughts on all this? Is this useful to do this sort of big macro look at where we are, UK PLC? So looking at the economy, how we're going to link it to the property market in a bit, because ultimately at the end of the day, we're trying to make better investments or better investment decisions as property. What's your thoughts on what we're seeing in terms of, are we in a good place? Are we in a bad place? It feels like the sentiment, mass media sentiment, is turning into positive. It feels like, oh, we've peaked. We're at the end of this. Right, we've won the war. Inflation's almost down below, Sunak's target for the end of the year. Interest rates on mortgages are coming down. We just have to sit around for 9 months, and next summer it'll all be great again, right? The property market's going to be kickstarted, and we'll be back buying and selling with interest rates nice and low, and it's all gone away. I'm not convinced, team. I'm not convinced, but let me know your thoughts. Anyway, let's finish this off. Business insolvency. So I just want to go back here. Let's just look at this one again. Right. Fall in GDP equals recession. Recession generally equals businesses going out of business. Businesses going out of business generally leads to higher unemployment. Higher unemployment takes us all the way down here, and we see a fall in house prices. Okay, so this is why they are so intrinsically linked. So let's look at where we are with business insolvencies. And again, I just want to caveat here that the governor of the Bank of England said we are barely halfway through feeling the effect of the interest rate rises. And I think you could say, look, I'm not a chartist, so you might go, oh, we got a nice hard line there. That's where it's sitting. Personally, I just go, look, we've got an upwards trend in business insolvencies. And if this is where we are now, right, and that's from, where's that? That's sort of from the beginning of 21, where we had all that support from COVID to where we are now, 2-3 years. We're going to see another 2-3 years of these interest rates filter through. If this continues up, we're going to see that unemployment go up. The unemployment figures we'll get to the unemployment figures in a sec. The crisis triggers to see a full-blown property meltdown are three things. One, affordability, i.e. we can't afford to service our debt. Two, negative equity, i.e. Our houses are worth less than the debt we've got on. We're now a forced seller, but we can't actually get everything we need to pay off our debt. That's a very bad position to be in. That accelerates a crash. Third, and most importantly, and this is the thing, this is the absolute inflection point right now, is unemployment. The one thing that is stopping the property market from going into meltdown is unemployment and lack of forced sellers. So I want to get right to the crux of this video today, this live stream, and the title, when will we see the property crash? I'm not going to give you an answer on that, by the way. But what I will give you is the trigger that will go from, if you remember, there's three scenarios, and I always talk about these three. One is that we're temporary blip and we'll go back to uptick. That is way gone, right? We're not going to see that scenario. Scenario two is shallow correction over a longer period of time. I've always said, looking at the data, that's what our most likely probability is. Number three is we're going to full-blown market meltdown, which is greater than 10% plus nominal house price corrections year on year. The only way we're going to get to that is if we see a massive spike in unemployment, I believe. And I believe the reason we are not seeing that, and the reason why I've always said that we're going to see a longer and more protracted and shallower. Now, shallower does not mean in terms of peak to trough, it won't be the same. I just mean it will be on an annual basis less, is the tight labour market. And there's loads of factors behind the tight labour market that we've got at the moment, even though it's softening. And different sectors, I spoke to some people last week about this, and on the week before, different sectors are going to be affected differently. I'm in construction, very tight labour market. But that is the thing, that is the trigger that will cause the avalanche to happen if we get there. And I know it's very easy to sit here and try and get clicks on YouTube and say, we will see it, the economy will break, and we'll see massive unemployment, and we'll see the housing market crash 35%. Which I know there are commentators like Charlie out there who talk about 35% nominal house prices. It could happen. I don't believe it will, right? Because I don't think we'll see that big trigger. I don't think we'll see that big capitulation in terms of unemployment. But I could be wrong. We'll see how it goes. It could, if it does trigger, it will go really deep. If we do see that spark, it'll go really deep, right? And this is the factor. I'll leave it up to you. What's your thoughts? Do you think we'll see that unemployment, spike? Do you think we'll see that trigger that puts the market into total meltdown and we go to 35% nominal? Because at the moment we're about, 5% peak to trough? Or we're not a trough, peak to where we are now. Look, I'm going to flash this up. This is the unemployment, the current sort of unemployment figures. We do see the trends are, we've got some lowering. There you go, look at this. Lowering of employment rate. We've got increase in unemployment rate, and we've got an increase in economic activity. But this data is so skewed, so flawed. Okay, it's such a small data set. It's so inaccurate. Even the ONS is saying this is actually a load of hoop, and we're trying to use other methods to actually calculate what's going on with the labour market right now. And nobody really knows. They say, when they come out and say we're not flying blind, it means they probably are flying blind, really, and they're using experimental techniques to work out where we are. I don't put any faith in these figures in the slightest. I believe it's probably worse than it looks, but we've still got all these other factors to consider, right? Anyway, let's move on. So, why is the market not crashing? Well, that's it. That's the reason. Lack of forced sellers. Okay, why are we having a lack of forced sellers? Sorry, I've got a cracked rib on both sides at the moment, so I just tweaked it. Sorry if I winced there. We have a lack of forced sellers mainly because there's a lot of liquidity in the system. There's still a lot of people who are on cheap fixed rate debt. And don't forget, the banks have a charter with the government that they're not going to start repossessions until 12 months after they would have done, right? Or after they could have started repossessing people. So you've got a lot of factors here which are not forcing and flushing people out the market. What I do want to do, if we've got time, is just quickly go through the Rightmove report, just to look at the sellers' asking prices right now to see what is potentially happening. But I want to focus more on that forced seller bit at the moment. So something that I'm glad came out, not glad, it seems like when you start doing YouTube and you're doing sort of things every week and you're using quarterly reports, all of a sudden you start training your mind and your life goes in these quarterly chunks. We've had the next set of mortgage and arrears and possessions data for Q3. I just want to zoom in on these. So this is fascinating, right? I love this, and I think this is a really good indicator of where we are in terms of different sub-markets in property, because for a start, this data only starts when people are 2.5% or more in arrears. So we don't see all of the people who are in any sort of arrears. So if somebody's, one payment out, they're probably not going to be 2.5% in arrears. I worked it out. If you've got a 75% loan to value mortgage, 2.5% in arrears means you've missed 5.5 months. So we've got some, just to be getting in that 2.5% of the outstanding loan in arrears, you've still got a fair amount of payments you've got to miss. So let's have a look at the resi. I think these graphs are easier to see. So this is the residential market. Okay. So we are seeing a very definite swing up in terms of people in the 2.5 to 5% bracket, which is the teal color. And if we look at it, we are, here we go, we're 10% quarter on quarter and we're 36% year on year, which is quite a big percentage. I think 10% quarter on quarter, right? We're starting to ramp up now. However, we need to clarify we're starting from a very low base here. If we sort of zoomed out and looked at everything that was going on in 2008, right, the amount of possessions going on were 10 times what they are now. All right, so we're still not seeing a lot of forced sellers. What I do want to show you is this one beneath us. And look, team, if you are into, I'm just going to come off this. If you are into property investing, if you want to take advantage of what we're seeing right now, this is the graph that will be telling you everything that you need to know. Okay, this is where the opportunity is, and this is where the opportunity is going to be for the next 2 years. And it's where to actually go and find the motivation, because right now the motivation is not in the residential sector, right? We're not seeing lots of distressed sellers, forced sellers being repossessed by banks. We're seeing a lot of people with liquidity, relatively. I'm not saying there aren't people struggling with their residential properties that are quite happy just to sit on them. Let's compare that to the buy-to-let market, right? And just look at how those graphs are different. So we are seeing in the buy-to-let arrears, and this is, falling through from everything I said last quarter when we looked at this, massive increase in arrears now. So let's look at this. Buy-to-let, quarter on quarter, 33%. By the way, I'm focusing on this teal one, the 2.5 to 5% to it. In the 2.5 to 5, we're gonna start to see more people go into the next brackets as well, right? So you can see here, quarter on quarter, 5 to 7.5%, 48% quarter on quarter. But this one's big, 33% quarter on quarter increase. And year on year, 174%, right? We are now talking significant numbers of investors in the buy-to-let sector are seriously struggling to make their payments. And that's because the effect of those mortgage interest rates are going through much more quickly, right? And there's a lot of people who are over-leveraged, who take loads of cheap debt and are just about got investment properties that are washing their faces. And now that the interest rates have changed, in addition to Section 24 coming in, which is obviously the tax, inability to offset mortgage interest against tax if you're a high rate taxpayer, plus a load of the regulation and legislation changes, right? The buy-to-let sector, and by buy-to-let sector, I kind of mean the vanilla buy-to-let sector, right? Not professional property investing, two very different things. But this is where the opportunity is, with people now in serious trouble and offloading. And if anybody is serious about looking at where they should be finding the opportunity, that is where it is. But regardless, again, we're seeing another quarter trends go up. Don't forget, repossessions aren't going to be starting yet because the banks are not. And interestingly, right, so let's just go top and bottom here. So you can see, right, we've got a definite curve starting to come up. This is with the whole market in terms of arrears, right? But when we come down here, this is in the possessions. We can see the possessions coming down. Now, look, obviously that's because the banks have a charter that they're going to be waiting 12 months. So even though the arrears are going up, the banks are not starting the repossessions, and that's going to see next year, we're probably going to start to see those repossessions starting to come into the system. Because it doesn't just suddenly mean that banks are going to let you off all this debt and just go, no, don't worry, don't pay us, it's fine. They will come a knock in at some point. And if we do go into a recession, so here's my thoughts on all of this. If we go into recession and if we start to see that sort of spiral down, in 12 to 18 months from now, that is going to go full on death spiral, right? Because you're going to see all of this backlog of debt, which, by the way, is now debt accruing debt, because you've not paid, you've not serviced the debt, and that's probably going to have more debt on it, right? And they're all going to start to be chased, and it's probably going to be after the election, and it's going to be horrible, right? If that's the case that we get into, unless people can, carry on to service their debt. So it's interesting, right? Again, I'm going to get to questions in a wee bit. Sorry, I know we're probably going on quite a lot today, but we had a lot. I did say we had a lot to cover. The one extra thing I want to cover then before we finish is in the backdrop of all of that, which, by the way, is not a huge amount of brilliant news when you look at the economy, when you look at GDP, when you look at the UK property market. In fact, let's just go to see if it's now filtering through. This is the Rightmove house price index, which came out today. And don't forget, Rightmove is basically asking prices. It's newly listed asking prices. So we can see that average new seller asking prices dropped by £6,000 or 1.7% this month, right? It's a large drop. If we go into price and activity trends, right, we can see this drop month on month. And I want to just zoom out on this and look at the overall 5-year asking trend. Earlier in the year, I was talking about double top with the housing market. We had what looked like to be the peak in nominal house prices. Post mini budget, we saw a little correction or crash, even like if you pro rata it, a crash down. And then everyone's like, well, okay, actually, it's not too bad. We've recovered. Sunak's in, steadied the ship. Swap rates came down, sentiment came back in, and this Q1 this year, or sort of spring this year, we saw quite a lot of, renewed optimism before inflation went sticky. And when inflation went sticky, that was almost a double top, and now we've been coming down since. And it does look like we're now seeing a sustained downtrend. If you were to chart this, and I've got it on my laptop, so I can't actually draw on it, but if you were to chart this now, we've got a channel with asking prices coming down. So as we run into Christmas, where we're going to be slowing down even more anyway, okay, sellers are starting to go, oh dear, right, I'm now starting to be realistic. So are we starting to see the first signs of this coming down? If we look at the rest of it, we do have some other interesting data here, right? Average stock per agent is not going anywhere. And this very much marries up with what Zoopla are saying. Now, I've seen a lot of people talk about the last Zoopla HPI, where you've seen a massive decrease in demand, buyer demand, but you've seen a big increase on stock on the market, so stock per unit, or stock that's not sold. And people are saying, look, there's a huge supply-demand imbalance now, with demand going up and demand going down and supply going up. I'm just going to see if I should have thought this earlier. Let me just have a quick look, see if I still have the slide for that Zoopla report. I actually don't, but there's 4 parts of that Zoopla infographic, and the one that nobody talks about is the flow of new supply is negative. So even though we're seeing more stock on the market, it's because the existing stock isn't selling rather than a massive influx of new supply. So Zoopla was saying influx of new supply is now negative. So we're seeing less come onto the market, actually negative amount come onto the market. So we might even be seeing that stock start to dwindle a little bit because people just aren't putting their properties on the market. And this actually marries through if you look at this, right? We're not seeing, if you're seeing buy demand crash and loads of new stock coming onto the market, then your average stock per agent is going to be going up unless there's suddenly loads more agents springing up, which is unlikely, but it's staying steady. So we are not seeing that influx of supply right now. And that is causing that paralysis. We can see that the average time to buy is increasing. You can see post mini budget, okay, we went boom, massively up. Then we saw the recovery. People started selling more quickly. And since then, it's been slowly edging up. And we're now at the same average number of days to sell a property as we were at the peak of it post mini budget. So it'll be interesting to see where the trend goes from there. Have a look at the Rightmove HPI. I'm not a massive advocate of it in terms of a house price index to analyze the housing market. They've got some interesting stuff on affordability. We can see that it's still very expensive to be buying for a first-time buyer with a 10% deposit. Of course, that is before you look at putting your mortgage out to 40 years, right? Bank of mum and dad, all that sort of stuff. We can see that the cost of rentals has flatlined now. So the cost of renting a property seems to have peaked. And this is the ability to afford a first-time home. And what we really need to see is this affordability start to come down, to start to level everything off, right? This will be the soft cushioning. If it's not coming down, we're not going to see that soft cushioning. And at the moment, right, we're flatlined, but we're not coming down. We want to see this come down. So what can we take from this Rightmove HPI? Sellers are starting to get realistic, but could it also be that more cheaper properties are coming on the market as well through Rightmove? If we use the argument that if the Rightmove is saying property is more expensive, it's because more expensive properties are being listed. We have to also be cognizant that the argument of it's dropped a low because now we're seeing more cheaper properties come onto the market could also be the case. Okay, so that's something to bear in mind. Anyway, I want to leave you with a bit of analysis on the Savills report that came out last week and caused a few of my fellow YouTube brethren to say property prices up 20% in the next 5 years, which of course is a massively confusing headline and flies in the face of everything. So let's see what Savills talk about. First of all, I showed this last week. This was an optimistic view of a company called, where is it? There we go, Pantheon Macroeconomics. Said that they'll see a material recovery next year as the MPC start to reduce the bank rate from May. So I think this was before the last MPC meeting last week, where they came out with a narrative that says it's probably not going to be May. So this Pantheon Macroeconomics talking about they think the property market can get back to 2022 peak by the end of 2024. I think that's about as bullish as I've seen. I don't buy it, right? This is what came out of Savills, so a piece of Savills research on the market between now and 2028. So basically the next 5 years. Now, I just want to focus on the top, UK at the top. Don't worry too much about the rest of it. An interesting infographic giving us rain, cloud, sun, where it's showing it expects 2024 a 3% correction or a further 3% fall in property prices, which, by the way, is pretty much what Zoopla are saying, 3% next year. 2025 is looking at a 3.5% rise. So basically 2 and a bit years from now, we're going to be about where we are now is the prediction. And then into 2026 and 2027, we're seeing 5, 6.5%, and then 5%, which gives us a 17.9% or basically 18% over the next 5 years. Now, I think this is quite bullish, okay? So, of course, what I wanted to do was look at the actual model that they put into this to come up with those figures. So here's the model, right, just to break it down for you. They are modelling the interest rates have peaked. So we're not going to go above 5.25% base rate, and mortgage rates will now come down. They've modelled that we hit target, which is sub 2% by the end of 2024, so about a year from now. And they have modelled the interest rates start to drop by the end of 2024 as well, which, to be honest, I think a lot of people are in agreement. I was saying no earlier than August next year. Maybe it comes back a little bit, sort of pushes back a little bit. But I don't think it's unrealistic to see interest rates start to drop by the end of 2024. What level they drop from, I still think there could be easily another 1, if not 2 0.25% rises that we see over the next 3 to 6 months, depending on what the CPI does in Q1 of next year. We'll talk about CPI then. They then said, and this is the bit that I don't necessarily agree with, they've modelled that interest rates will settle sub 2% by the end of 2027. So if we go back to their model here, right, that is quite a rapid fall off of interest rates. And if I go back to where effectively we've got the IMF report, and again, look, I'm not saying the IMF are right or wrong. 2027, we still got a base rate of over 4%. So that's quite a big disparity. Now, I agree, right? If we see interest rates sub 2% by the end of 2027, I think the figures that Savills are talking about there are easily achievable in terms of the demand coming back to the housing market. So the key thing is, where does interest rates go? The general consensus seems to be they're not going to drop off that quickly, and they're going to, would probably settle higher. And a lot of this depends on what happens with the inflation. If it suddenly falls off into 2024 and undershoots massively, I think, yes, we could be, sub 2%. I don't necessarily feel that's where we're going to end up. And I say that just in looking at that core inflation, but also owner-occupier housing costs and how that's changing at the moment. So let's talk about how else they've modelled this, right? So this is the next chart they had. So we've got here, you can see, now they've taken this from Oxford Economics, apparently. I don't know when they took this data from, where the data source is, but this line here, Oxford Economics, says, end of 2024, base rate 4.75. I'm not going to disagree with that. 2025, 3.75. Also, I don't think I'd disagree with that. Then we go 2.75, 1.75, 1.75. I've already said I'm not convinced that's what we're going to see. With an average mortgage rate dropping to sub 3% again is how they've modelled this. They've also modelled inflation, and this again is from Oxford Economics, at 1.9% by the end of 24, 1.7 by 25, 1.4 by 26, so undershooting the 2% target. So if we do undershoot over the next couple of years, it's likely those interest rates will come down. So we'll just have to see what happens with that. And it is a possibility. Is it a high probability? We don't know. We've also got fairly flat nominal wage growth going forward now. So when I talked earlier about nominal wage growth peaking, or we think it's peaking, it's coming down, we've seen huge, like double-digit nominal wage growth. We're now looking much more, sort of traditional 2.5, 2.7, 3.2, but that's not a huge amount. And GDP of not a huge amount either, right? So wages, GDP, fairly static. So that's the model that they're working on. They've modeled the affordability as, effectively, do we say dropping off or increasing? Affordability increasing. So even though this chart's dropping off, it basically means that the affordability is increasing for people as those interest rates come down, and that's quite a strong drop off. However, and this is what I'm pleased they did, because if anybody just says this is our prediction, and that's what they say, right? They're basically making it up. At the end, they've got potential variations around their central scenario, which I've just talked to. So let's look at their potential variations. So over here on the right, so basically you can see here we've got higher activity, lower activity. This is in the housing market itself, so in terms of transactions. And then base rate. So they've modeled we're going to end up at a 1.75% base rate, but then we've got two scenarios of going down to 1% base rate versus sticking about a 3% base rate. I still think we could be sticking a higher than 3% base rate in a few years' time. Anyway, higher rate scenario. 1, affordability approved by more significant price falls, enabling increased activity. So basically they're saying, if we do see the base rate stay up at 3%, we're going to see much bigger house price falls. House price falls is going to stimulate activity because it will get to a position where affordability increases because house prices come down and more liquidity comes into the housing market, more people buy. We've got another high rate scenario where affordability remains constrained, right, because interest rates are high, but low turnover of stock limits price falls, which is exactly where we are right now. This is effectively our scenario right now. Stock nowhere. Nobody's coming on because everybody's sitting on their hands waiting for the expected drop of interest rates next year. And either we're going to run out of liquidity and people are going to, we're going to go into recession, people are going to lose their jobs and stock comes on, or interest rates are going to go down and, affordability improves and it's going to, more stock's going to come on. It will happen at some point. So that's the higher rate. Lower rate scenario is interesting. Actually, we've got a lower, improved theoretical affordability, but lower rates likely the result of a worsening economic outlook, damaging buyer confidence. So what this is basically saying, I think if rates are going below 1.75%, it's because we're in recession and we're having to cut rates very quickly. And actually, if we go back to our nice little sort of, cyclical symbiotic pinwheel here, this is what we're talking about. If we go into recession, it all starts, going like that. So that's what they've modeled it on. I'm going to say right now, I feel, right, we're going to be somewhere around here, or we're going to be on this one here. I think this one seems, personally, the least likely probability on the quantum of possibilities is my gut feeling. But there you go. What do I know? I'm just a YouTuber. So because I'm a YouTuber who clearly, is not an economist or an analyst and doesn't get paid to do this, let's go for a CPI sweepstake, team. Okay. This week, with everything we've just spoken about, let's talk about CPI because we'll go live on Wednesday after it comes in. I would like you to fill in this. Comes out in 2 days' time. So the last, I've just drawn over it. The last three have been CPI. So headline CPI, where do we go? The governor of the Bank of England said sub 5%. I'm going to put mine on at 5.3%. Now, the reason I've gone for that, and by the way, it's just a bit of funness. Please don't hold me to it if it's like sub 5 or above 6 or something like that. The reason I got 5.3, if we remember the data, if we remember all of this, let me find the CPI, latest CPI charts. Right, we are about to lose out of the data October 22. October 22 saw the CPI 1 month rate peak at 2%. So that's going to be falling out. Now, last month, we saw month on month grow by 0.5%. Month before, 0.4%. So I'm going to hypothesize, because Brent has not gone up as much as it could have done. It's actually fallen down a little bit. Let's just leave it at 0.5%. And now I know it's not as linear as this, but if we're going to lose a 2%, and if we see a 0.5% month on month, we're going to be roughly 1.5% down from where we were. So I'm going 5.3. That's my rationale. It could be way off. I don't really care too much. It's just a bit of fun. We will see a significant drop. And everybody will go, amazing. Sunak's hit his target, or he's just about on his target. We've solved inflation because it's come down by almost 2% in this month. If it carries on like this, it'll be amazing. And confidence may even come back in, right? Mortgage swap rates might go down. Mortgage interest rates might go down. The narrative is we've peaked. Everything's come down. We've won the war. Let's just hold fire on that a little bit, because just going back into this, okay, when we go after this month and we go into the next quarter, we see a 0.4, a 0.4 and a minus 0.6, which means the next quarter, we're going to lose a net plus 0.2% rise in CPI. So let's just hypothesize we carry on at 0.5% for the next 3 months, which is a net 1.5, and we're losing 0.2. It's not inconceivable that we'll see secondary inflation over the next quarter. So December, January, February, going into Q1 next year, secondary inflation goes back up. Does that send the shockwaves through the markets as they're quite reactionary, and we see spikes in swap rates, and then we see the confidence dip? And could that be the trigger? I don't know, but I feel that we're not quite out of this yet, despite what happens on Wednesday, where we are expecting a large drop. There we go, team. That's what I've got for you this evening. Hopefully that was useful little run through of where we are on a big picture. And I wanted to do this before we go into the CPI drop on Wednesday, so we have a bit of preamble to understand what's going to be going on. What I will do, let's just see. We have, oh my gosh, team, we've got loads of comments. I will skim through them as quickly as possible to find comments or questions directed at me. And ask those questions. I'll put them on the screen and we can try and go through them. And by the way, thank you very much for everybody coming on. I hope it was useful. While I'm doing that, while I'm finding some questions to put on, I would just ask, as always, again, a little bit self-indulgent, if you're looking to get into property, if you're looking to understand how to invest in the property market, I recommend you start with this white paper. It's robstewartglobal.com/white-paper. It's a free PDF. It'll take you about 30 to 40 minutes to read it, and it's going to give you basically the strategies I'm using right now to continue adding to my portfolio, because there are some fantastic deals out there. So let's see what we've got. Thanks for all the nice comments about appreciating the work, by the way. Okay, let's have a look. Right, let's come off that. Let's go full screen. Let's see some of the comments. So we've got Jeremy Hunt. Aldo, thanks, Aldo, for your comment. Jeremy Hunt is talking about stamp duty cut. Surely a disaster for the already wildly unaffordable housing in the UK. We're still 9 times earnings, still reeling from the 25% uplift over COVID. Yes, I agree with you, Aldo. So this it's always interesting as we run up to election time. What rabbits are they going to try and pull out the bag to stimulate? Now, one of the things that's going to go sort of, contra to that, when I talked about all of the extra debt we've got, all of the losses through the QT program, basically they just do not have funds available to play with. So everything's got to be balanced from somewhere, and they're not stupid, but I think they will go for some headline policies for the housing market. Do we need anything to stimulate the housing market? In terms of how I think, what I think should happen is no. I think they need to let it correct in this slow and steady way to let affordability get back to that sort of six times earnings ratio. I think it'll be more healthy for everybody when we look at wealth, generational wealth, passive versus active wealth, rich versus poor, all of this sort of stuff. So many societal issues that actually come from these rapidly rising passive asset price booms that we've had over the last 40 years. It's weird because, as a property investor, I think, well, look, surely you want to make money from property. Yes, but it's not about passive value add, which of course, I'm not going to say no to, but when you look at the societal issues that it causes, that rich versus poor, house versus have nots, it causes a lot more than it solves, which is why when I invest, I don't assume any capital appreciation. It's all about return on capital employed and generating cash flow. Okay, so I don't think they should stimulate it. I think it should be a correction, slow, steady, so people don't lose their homes, and allows more people to buy. So yes, I agree with everything you say there, Aldo. Right. Let's have a look at this. Extinction Channel. Today I heard the majority of sellers are mortgage free. That's also why prices are not coming down, because they're not serious about selling anyway. What is your point of view about this statement? Impossible to say without looking at the data on that. I think it absolutely goes with the narrative that we're not seeing those forced sellers, and people are actually just trying their hand. If they can get what they want, they'll sell. If they don't get what they want, they'll hold. And that's the point about forced sellers. We are not in a position where we're seeing forced sellers. In fact, there was a slide here that I didn't go through from the Savills report that I will just highlight for you. And we can just go through it quickly. Sorry, I just have to take this off the broadcast quickly. Right. This is effectively what Savills is saying is going on right now in the different market contexts. So this is what kind of maybe answers the question. Mortgaged homeowners, although you're saying people without mortgages. Anyway, home movers will likely continue to hold off if they can do so until interest rates fall next year. Those that are active are likely to be more needs-based, having to move due to a change in circumstances, which is kind of actually contrary to what you were saying there, that the people who are selling are people who are selling because they need. But I do totally understand what you're saying, that a lot of people have just had property on for a price that they want to get, and if they don't get it, they're actually quite happy. They're not being forced to sell. There we go. So yeah, I'm with you. I'm with you. So K-Art saying, work at tech company, wages above average, but a lot of the conversations about cost of eating out, holidays, bills. Yeah, so I think, what are you saying there, K-Art? Are you saying that people are now talking about they don't have the liquid funds to be able to spend on eating out all the time, holidays whenever they want, paying their bills, buying the nicer cars? So it's not a case that they're just going to be going insolvent or illiquid or going bankrupt, but you're just having to pare down on their costs. Think about what they're spending on, which is indicative of where we are. Let me know if that's what you mean. Paul saying works in tech and lose all the jobs with AI. Yeah, I agree. What I'm going to do actually is I'm going to go to the end. So that's probably got some more recent questions or comments. Let's go this. Regreen. Rob, what are your thoughts on downsides and incentives for the boomer generation to free up family homes? At the moment, there are none. The problem is, I think when you tinker with markets, it generally doesn't. You will have this law of unintended consequences of what actually starts happening. I think these things sound nice. My honest impression is there's plenty of large houses on the market for sale. I think there's plenty of boomers that are happy to downsize. Should they be incentivized for downsize? It's going to artificially create a supply-demand imbalance in a different piece of the market. Ultimately, property is overpriced at the moment. Even though we're correcting, it's overpriced. And I think the main thing that we need is that properties become realistically priced. So free market, it's easier for everybody to get on the various stages of the ladder. I don't feel like it's boomers holding on to stuff. If anything, so we're buying a place at the moment, which is actually a boomer seller. It's actually sort of a complex, large manor house with a couple of other buildings in it, which they've lived in for 30 years, multi-generational family. They desperately want to downsize. Kids now, old, not, in their 30s, something like that. Other houses going, they've got this space too big, they want to move. They had this place on the market for a while, and it wasn't getting any interest at all. We've gone and negotiated a very quick sale at a very aggressive price point, which they're happy to go for, because even though it's, let's say, 15-20% below what they wanted, it's still a huge amount of equity in there for them, which they're going to release and go into a smaller place. But they haven't been able to downsize because nobody wants to buy the big houses, right? Why do nobody want to buy the big houses? Because they're blimmin' expensive to run these days, a lot of these big houses. So actually, there's other things we probably need to tackle first, I suspect, and then slice them up into flats or things like that, or knock them down. So yeah, does it free up family homes? I don't know. It's an interesting one to look at. I'm very very happy to look at that a bit more. Paul saying Labour. What happens when Labour win the next general election and spend big money that's not there, even with massive debt? Yep. Let's see what we got. Oh, interesting. Aldo talking about taxing Airbnb. Yeah, Brody, let's just put this. I think this is an interesting thing to comment on. And then we'll take one more comment and then we'll turn it off. So we're over an hour. The problem that inflation is supply side and that's not improving quickly. I agree. And this is why it's not suddenly going to magically magically go away. And it's also very dependent on other factors coming in. We, of course, have the crisis in the Middle East at the moment. That could spill over. That could create more supply shock, which, of course, could feed into the inflation. Brent seems under control at the moment. I've not actually looked at it for the last week or so, but I know it's spiked up. It's now come down again. That's obviously one of the things that's been feeding into the inflation over the last couple of months now, is the cost of motor fuels and transport. So, 100% supply side, and we could see supply shock still. And I think a lot of people are now talking about this, that there are lots of third-party external factors that could come in here and totally change the dynamic in the picture again. All right, team, it's been a pleasure. We've been an hour, so I need to... sorry, I'm just trying to work out how to get that off. There you go. I lost it, Brody. I'm going to sign off for the evening. I hope that was useful. Let's see if we've got any more predictions on the CPI. KR 5.1%. Just one. We've only got one prediction. We've only got one prediction. There we go. I have 5.3. KR's 5.1. We'll see where we go with it. Team, have a great couple of days. We'll be live Wednesday night to talk about the CPI data. We'll crunch through that and go specifically into all of the subsections there. As always, feel free to put the comments in the replay. I'll always come back and answer them if you have a specific question. Otherwise, please do me a favor. I'd love to get to that 3,000 today, tomorrow. Certainly by Wednesday, hit that 3,000 mark. It's a total vanity metric, right? Hitting round numbers. And I don't usually talk about round numbers, but I set the target for Christmas, and I think we're going to be well ahead of that. So it'd be great to help me out with all the work that goes into these. So look, it's been a pleasure. I will see you on Wednesday. Have a great couple of days.